It's Christmas Eve, and what does Santa have under the tree for us this year? A continuation of the unofficial recession, along with subprime auto loan crisis, bank liquidity crisis, and a crash in the prices of used cars. So a little bit of economic coal is under the tree for us this year. The good news is that inflation in most goods will start to slow dramatically. This is because the economy has shifted back into services. And this will lead to a deepening of the earnings recession we saw in tech earlier. We'll talk more about that in a bit, though. This slowdown and the fact that it hits high tech companies first is predicted by Austrian economics, by the way. And if you're interested in learning more about this, then see my other videos to learn about the Austrian business cycle theory, the order of goods, and the Cantillon effect. But for now, let's get into some macroeconomic updates and look closely at the November retail sales report of 2022. Here's a chart of those sales. According to the chart, you can see that November, usually a period of retail madness, including Black Friday, proved to be an abysmal month for the sales of goods. Cars, building materials, furniture, electronics, sporting goods, and clothing were among the numerous products that suffered a sharp decline, even with Black Friday sales included. This report basically dashes the hopes of a traditional Santa Claus rally and is part of why the market has been so down lately. The bear market rally basically topped out at around 34,000 in the Dow 30. Inflation is dropping in goods, but in services it's a different story. In fact, when we look at restaurant and food sales, we can see that they're at an all-time high in raw non-inflation adjusted spending. But due to the labor crunch in services, we will continue to see some inflation in services longer than normal in a recession cycle. This will give us some conflicting signals, specifically robust employment numbers and elevated services spending, which is a huge portion of our economy, much further into recession than normal. These two signals are going to flash green even though the economy is flashing red. Well, that is until the consumer finally stops or at least slows all this credit based spending that's going on. I think we're very, very close to that point. We've already crossed it. But when that happens, we'll finally see the earnings recession spread to the services category. And if it comes to that, the media and the Federal Reserve will no longer be able to deny the recession that Main Street already knows is going on. This is by design, by the way. All this is by design because the Federal Reserve knows inflation can be very hard to knock out once it gets spiraling up. So let's look at this chart showing how recessions have knocked out inflationary spikes before. As you can see in the chart, recessions, they're fairly effective in knocking down inflation. As a matter of fact, they're one of the only tools the Federal Reserve has. Let's turn to the bond yield curve inversions. The 10-year minus the 1-year treasury spread, it's been inverted for a while. The 10-year minus the 3-month yield spread, it inverted in November. For almost 2 months, the 3-year bond rate has been lower than the 10-year note. This inverted spread finished at minus 66.3 basis points in the New York session on Tuesday, December 20th. Historically speaking, this is an ominous sign. 8 recessions in a row were preceded by similar yield disparities. Plus, the counterpart between the 2 and 10-year yields has been stuck at negative levels for nearly 6 months. It's important to note that these yields are not adjusted for inflation and haven't been when used to predict recessions. I mention this because economist Professor Campbell Harvey, who discovered this measure, is saying, quote, once adjusted for inflation, we find that the yield curve is no longer inverted, but instead flat, indicating lower growth that could mean we potentially avoid a recession, unquote. I disagree with Professor Harvey. He's never taken this stance before, and that they've never inflation adjusted these yield curves before. So this tells me that the propaganda machine's in full denial of a recession here. Now let's look at the subprime auto loan crisis. Banks have started to increase standards for lending, and the number of people falling behind on their payments is nearing pre-pandemic levels. At the same time, lenders aren't being so lenient this time around, with industry analysts concerned about an increase in repossessions. So we know the recession is here in the United States and has been for a while. But does our exporting of inflation, when combined with these very quick rate hikes, mean that will cause a global recession? Let's look at how some of our allies are doing. Over in Europe, our rate hikes forced up the rate at the Bank of England. This caused both a crisis in the bond markets, aka the gilts, and the pension funds. Many more quick interest rates, and there'll be huge problems in the UK and other places abroad, which is part of the reason that the Fed is slowing down the rate of interest rate hikes. They don't have much headroom left before they start knocking over international dominoes. The UK pensions will go bankrupt if the rates get too high too quickly, and the UK's bond market's liquidity will also dry up. And that's the primary markets. Look at Main Street. About 40% of ARM mortgages in the UK are set to adjust up next year, according to the Bank of England. And that's right after these huge interest rate increases by the Federal Reserve in the United States here in 2022. There's going to be some massive mortgage increases for for the folks in the UK. Inflation and housing is not done in the UK because of this. Look for another spike in 2023. Meanwhile, over in Japan, the effects of the Japanese bond liquidity crisis are still being felt, and investors remain wary of long term investment in government bonds into 2023. In response, the Bank of Japan has just issued a surprise policy tweak for bonds in an effort to increase liquidity and restore investor confidence. This new policy, it involves the cutting of interest rates as well as other measures such as fiscal stimulus packages and tax cuts. It's hoped that this will lead more investors into buying long term government bonds and restore liquidity in the bond market, protecting against further recessions. I don't think that's going to be effective. I don't think that's right. I think you're going to see a new set of recessionary pressures in Japan. Listen, it's very clear the Federal Reserve has made a critical mistake by relying too much on lagging economic performance indicators in their decision making process. And the Fed, because of those lagging indicators, doesn't realize we're already in a recession or they don't care. And even if we weren't, the other indicators at this point have started to make the recession a self fulfilling prophecy. Despite our best efforts to make Santa proud, it looks as though we probably aren't making it onto the nice list this year. Tell me in the comments below what you think will happen next in the economic circus.